Alright everybody, welcome back to the Simple Markets channel. My name is JB. Now diving right into it, let me know if this is a statement that you have heard before. JB, I know investing is important, I know that I should start, but I just don't have a lot of money right now. I want to wait until I have a consistent income or a lot more money and then I can start investing. Well, today's video is all about that topic and I want to draw your attention here to the community. Of course, as always, they are killing it here, 17 art in a week. But more importantly, I want to talk about this little poll that I did. And it is very simple. So investor A starts investing $10,000 per year in the stock market at age 20 and continues until age 30 and then completely stops. They do not put another dollar into the markets after they turn 30 years old. Investor B waits until age 30 to start, but invests $10,000 per year from age 30 to 60. So this person, like you may have heard in the intro, they decide that they're going to wait until they're 30 because that's when they maybe get their stable job and a better income, and that's when they're going to start investing. They put the same exact amount as investor A, except this person is investing 3 times as much because obviously they're investing for 3 decades and this person's only investing for 1. We're going to assume they both make the same percent yearly. They're putting it in the same exact place, and let's just say 8% yearly to make it easy. Who would end up with more money by age 60? Now, as you can see, the poll is quite split here. This does not mean that this answer is correct, and I answered this one just to throw people off a little bit. But I want you to pause the video right now, take a few seconds, don't actually bother doing the math on it. It's more of a conceptual question. But who do you believe would make more by age 60? Is it going to be investor A or investor B? If you answered investor A, you are actually correct, and I know there's still people who are going to say, yeah, well, I knew that, and I'm still going to wait until I'm 30 to start. But for those of you that actually want to take action today, stick around to the end of the video. I'll talk about brokers. I'll talk about what you should put your money into to start. But more importantly, let's break down the math here for those of you that still don't believe. So this is a graphic that I showed at the beginning of the video. Now, this one was adjusted so that it wasn't as extreme. I understand that we have a lot of international students and not everybody can invest $10,000 a year. So this example here uses $3,600 a year, which is just about $300 a month. I guarantee that almost anybody watching this video can carve out $300 a month in their income. That amount can be something as simple as changing a phone plan, getting rid of a few subscriptions, whatever it may be. I guarantee you can find $300 a month in your budget. So investor A here, as you could see, they start with $3,600, of course, because they're investing in year 1. By 20 years old, they have $3,600 because they invested $3,600. They invest for the next 10 years until they turn 30 and then they completely stop. They never put another dollar in the markets and they simply let compounding take its role. Now investor B, they wait all the way through their 20s to start investing because they assume they need more money. They don't have enough to invest. They'll do it when they're older. Maybe they want a better job. Maybe they want a higher income. Whatever it is, they push it off until they're 30 years old. And honestly, the reality is this is what most people do. One of the wealthiest investors, Warren Buffett himself, started investing at 10 years old, and based on the idea of compounding, he made most of his money after his 65th birthday compared to his first 65 years on this planet. That is the power of compounding. Compound interest is known as the 8th wonder of the world, according to Albert Einstein. It is extremely important to understand this. So hopefully this visual gives you a better representation of it. Investor B invests over $108,000 in the course of his life over these 30 years, while investor A only invests $36,000. He's investing 1/3 of the amount, but he is making almost double compared to what investor B makes by the age of 60. This graph kind of shows it here, but more importantly, let's hop over to an investment calculator and let's type it in here so you can see the math for yourself. So of course we are going to start with $0 here, and after 10 years with a return rate of 8% like we decided on, in the stock market your money is actually compounding continuously because you have it in a fund that continues to grow and you don't remove it from that fund. And as we talked about in the example, you are putting in about $300 at the end of every month. For 10 years starting from 0, and here you go, you are at $54,965.71, and you contributed about $36,000 total because as we talked about, $300 per month for 10 years is $36,000. That $18,000 is called interest, and this is essentially the money that you made for free just based on parking your money in the stock market and letting it grow at that annual rate. Now, more importantly here, this is just after 10 years. This is not by age 60 like we talked about. So we can take this value here, plug it into your starting amount now, and you now have 30 years to go until you reach age 60. But now in this example, you're contributing $0 because now you're 30, you stopped investing, and that is about $605,896 at the end of that 30-year period. And more importantly, look at the interest on that capital compared to the amount that you put in. We still put in only $36,000 and you made $550,000 on top of your contributions. But more importantly here, let's just assume you continue investing after 30 years old, which I highly recommend you all do. That number more than doubles. And now your contributions are only $108,000, but you made over $892,000 in interest. But let's take a step back here and compare that to Investor B. Now, Investor B starts for 30 years straight. Their starting amount is $0. That return rate is 8% like we talked about. And then same thing, continuously compounding $300 at the end of every month for 30 years, and you end up with $449,000. Significantly less than if you just invested early on and started as soon as possible. Now, as you guys know, it's cool to show the math and whatever, but I'd like to try and help you guys at least get the ball rolling here. So I'm going to give you some brokers that I would recommend. So broker number one, this is going to be for people like myself who are inside the United States. I would highly recommend Fidelity. This is who I personally use. I've been putting money into Fidelity since I was 18 years old, and I continue to let it compound. And honestly, it is probably the biggest needle mover for my entire net worth, is being able to withdraw money from my trading income, put it into some longer term investments to keep stability and diversification, and then even keep some of the cash from my businesses and put that into an account as well. One more thing I want to recommend, there is great retirement account options for many people out there, and depending on the country you're in. If you're in the US, a Roth IRA, I think is a great option. It maxes out at $7,500 a year, but I really recommend capping that off. And then anything else that you have left over, putting into a brokerage account. Everybody also says, JB, I want to be rich by 25, not by 65. I completely understand that mindset, and I do recommend a brokerage account for those of you people because it allows you to do something with the money when it's invested. I have a ridiculous amount into the stock market, and whenever I want, I can pull out for expenses. I can pull out to buy property for my real estate business. I can pull out loans against that and buy any other asset that I want. It is extremely valuable to scale and compound your net worth. So it's not like having this money in the market means it's sitting until you're 65. You can do a lot with it. Now, number two, this is for the people who are outside of the United States. I would recommend Interactive Brokers. Now, of course, I have not used them personally, but a lot of my students have tried many different brokers, and this is the one that most of them agree with for those that are international. It does allow you some access to US stocks and ETFs, which is very important for those of you outside the United States. Historically speaking, the US markets and ETFs have performed significantly better than international markets, so it is important to have some access to that. Now, I am not a financial advisor. I have to say that this is not financial advice. But if I were you, I would recommend to get started as easy as possible, parking your money into something like VOO. This is essentially just the Vanguard, which is a broker's version of the S&P 500, and it is one of the largest ETFs for the S&P 500 and one of the lowest expense ratios as well. I personally have a large amount of my portfolio in VOO, and then from there you can learn more and start putting into other places if you want. It is a great starting point though. Even if you start after this video with $50, it is a huge win for me, and then in 5 years when it's compounding and growing on itself and nearly doubling, feel free to donate me your $50 as a thank you. But all jokes aside, guys, I hope that some of you watching this are going to go out there and start your investment account today. I have many more in-depth videos on starting your brokerage account, what accounts to choose, where to kind of allocate your capital. And then even if you are invested in the Simple Markets community, all the time I talk about my ETF portfolios, my different single stocks, things like that. And what do you know, one of my callouts from 2024 in October that I sent to my community was URA, which is a nuclear ETF. It was that shift from Apple, Microsoft, and Meta talking about a shift towards nuclear energy that made me put this into my portfolio with just a small 5%. But as you can see, right around that time of October 2024, we went down, took a little bit of a dip, and then absolutely exploded from there, being one of the largest returning positions in my portfolio, literally doubling my capital in 1 year. This one ETF alone basically was on par with my Forex trading account, which I doubled last year as well. But this one was completely passive. I put my money in October, I let it sit, and it compounded on itself and made about 100% returns in that 1 year. As always, thank you guys for watching this video. During the time of this recording, we are closing in on 20,000 subscribers. I cannot thank you guys enough. As you guys know, we already started posting 3 times a week instead of 1. We have about 10 short form videos going out every single day. So we are really trying to ramp up production here for you. I hope you guys appreciate it. Thank you all for watching, and I will see you guys in next week's video.